Bloomberg Audio Studios.
Podcasts, radio, news.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
All right, so we know a big day out in the Bay Area today with Apple and their new iPhone and new product launches. Mark Gurman, he covers all the technology stuff out there for Bloomberg News. Mark, I've already informed Tim Cook that I am in fact going to be upgrading my phone here in the not too distant future to the iPhone 16. I guess I am. Who cares? And they're very excited. Are people excited for this event here today? And if so, why?
Yes, it's all about the iPhone this year. This is actually going to be more of a muted release, right? So this is not a big year-over-year overhaul. Remember last year they added the titanium shell. This year is more about refinements, increased processing performance to better support artificial intelligence, improved displays on the Pro model, so slightly bigger screens is about a 5% display increase. But because the bezels around the display are smaller, that increase is actually going to be more noticeable than a 5% increase would normally suggest if you heard that. The other big enhancement is going to be a camera button. This is going to be on all four new models, both the low-end and the high-end models, and it basically works the same as a DSLR button, right? So you soft touch it to autofocus on a subject, you press it in order to actually take that photo or a video. You're also going to be able to swipe on it up and down or left to right in order to zoom in and out of a subject. So it's essentially the same camera controls that you've had on the display, now relegated to a hardware button on the side of the phone. And the bet there is that will help people take more pictures and maybe better pictures, which of course is going to translate to people needing to buy iPhones with more storage space, which obviously costs more, and bigger iCloud storage plans, which obviously will generate more revenue for Apple on both of those things, right? So it's, I guess, a win for consumers and a double win for Apple.
Does that imply then a super cycle definitely taking hold in 24, 25?
There's no iPhone super cycle. There have been some analyst claims over the last several weeks about a super cycle coming with these new iPhones. I would have to say that they're either making things up or getting bad information or just trying to pump the stock price for their own, self-interest, right? The reality is that the numbers that we're seeing in terms of iPhone orders from the supply chain probably indicate an annual decline on iPhone unit shipments. Now, an annual decline doesn't necessarily mean a revenue decline, right? Because they're adding new features for these higher end models, particularly making the lower end Pro model even better at that $1,000 price point, you may be seeing people who normally would buy the $799 version go to the $999 version, which could raise overall ASPs. In terms of an iPhone super cycle, that normally means big hardware changes. We're not getting that this time around. It also would mean that Apple Intelligence would be ready to go. But I would say it's half-baked, if even that. A lot of the new features aren't coming until December, and many more aren't coming until the middle of next year. So if you're anticipating an iPhone super cycle, if you believe there will ever be an iPhone super cycle again, I would say adjust your expectations for 2024, maybe focus on September 2025 when the iPhone 17 launches with more significant enhancements.
What is Apple Intelligence?
Apple Intelligence is artificial intelligence for Apple customers, right? So that's the Apple branded version of their AI platform coming as part of iOS 18.1 sometime in October. That's including summaries of notifications, that's including phone call recording and automated transcriptions, that's including transcriptions in voice memos, including voice recording in the Notes app. It's including Genmojis, which uses artificial intelligence to create your own emoji characters.
Which, side note, my daughter loves that, by the way. Like, they're making her own emojis. Like, she takes my phone and does the things, and she makes GIFs and all this stuff. Like, the young kids, they love it.
I think the Genmojis are going to be incredibly popular. I think it's going to be at the center of many of Apple's advertisements for these features, but that's not coming until December. So I'm not sure how that can sell new iPhones in September if it's not going to be available until December. So I have some big questions about where analysts get their information from, why they say the things they do, and why some of them are considered reputable. So I think that people need to be able to separate the signal from the noise. And that's why I'm so happy to come on here and explain and provide a dose of reality.
So, but the dumb question. So Paul gets his new phone in October. Can he just update the stuff when the cool things like the emoji stuff comes out?
Yes, he can, absolutely. And it's not a dumb question, right? So what we're going to see are Apple Intelligence features rolling out probably over the course of the next 6 to 9 months with constant software updates. Now, this is new for Apple. This is not something they've done in the past. Usually you get one big software update every September and you're pretty much set, say for bug fixes and maybe a couple enhancements here or there until the following September. This time around, it's going to be a gradual release. Now, why are they doing that? Because Apple Intelligence simply is not ready. There's a lot of testing that needs to go into this. And the reason Apple Intelligence has been behind is because they're responding late to this AI craze. They really didn't start getting to work on these AI enhancements until the second half of 2022, after they saw ChatGPT launch, right? This was really something that was developed over the course of 2023 and into the first half of 2024. And their development cycles for major new initiatives like this, these normally can take 3 to 4 years, right? But they did it basically in half the time.
So you raised a good point earlier, Mark, that there's a reasonable scenario, just given the size of the market, that there really are no super cycles, unlikely to be a super cycle again for the Apple iPhone. Is that a belief that's widely held out there?
It's widely held by me, and I think it's widely held by people who really understand this stuff. You know, the last time we got a true iPhone supercycle was back in 2014, 10 years ago, with the release of the iPhone 6 and 6 Plus. 2 reasons. That was the first time that they made substantial screen size increases to the iPhone. That was your first Apple phablet, right? Moving to the 4.7, 5.5 inch screen sizes, massive. Also, that was the same year where they struck the carrier agreement with China Mobile in China, the biggest wireless carrier in the world, adding an additional addressable market of 1 billion people. Right? So that is what really elicited that super cycle. And that was a 2-3 year thing. So that was great for Apple. We saw another big bounce in 2017 with the iPhone 10. Obviously, that was major in terms of ASPs, raising the starting price, right, by $300 from $700 to $1,000. That was a big upgrade with Face ID. Then we saw that again with the iPhone 12 5G, all 4 models at the tail end of 2020, at the top of COVID, when people were splurging on money, right? So that was a big one. But since the iPhone 12 in 2020 and the advent of 5G for Apple, we haven't seen major significant changes. Maybe they're coming at the end of next year. Maybe that will create a super cycle. Yeah. But I want people to know, don't expect one this year.
All right, we're going to talk more Apple in just a moment. Also, hey, Mark Gurman, thanks a lot. Really appreciate it. Bloomberg Technology Senior Reporter joining us from California.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Speaking of sectors good to look at, looking at Apple, it's down by about 1.3% today. It is their glow time event, as we've been talking about. But Bloomberg Big Take had a fantastic piece today. And we wanted to dive into it with Austin Carr, technology reporter for Bloomberg News. It's titled Apple's Rise from Rebel to $3.4 trillion World Power. It's great to get you on this, Austin. It was a wonderful piece, distracted me from my whole car ride into the office. Can you just connect all the dots from like the 80s until now?
You want me to summarize 40 years in a minute?
You bet. You bet.
Okay, well, really what this story does is chart why and how Apple found in its position today, facing a big antitrust lawsuit in the US, a lot of regulatory pressure in Europe, as well as a lot of really just skepticism and criticism for a lot of the partners and developers that have depended on Apple over the years. And it charts how basically Apple has changed from that 1984 era when it released the Mac. It was seen as this sort of disruptive force in the technology industry, to 2024, when a lot of people think that this is a sort of domineering force that needs to be disrupted. So we go through from the Mac to the iPod and iPhone up through present day with the release of the iPhone, the new iPhone 16 later today. And it's just really just putting all the pieces together about how Apple finds itself in that position now.
And Austin, along with Max Chafkin, you guys reported this story, just fantastic work. But for me, Cameron Galley, who does all the illustrations, just made it really cool and really interactive, some awesome stuff as always. So Austin, where do you think Apple goes from here? Is it just new products? Is it maybe getting more ingrained in our daily lives, if that's even possible? What do you think kind of a longer term vision is for the folks in Cupertino?
Look, I mean, I think a really good question for listeners right now, or even you guys, is just, they're going to release this new iPhone. If you guys are Apple users, have you ever seriously considered switching to a different device?
No.
Or is it just the default now that I'm going to upgrade to the iPhone 16, maybe it default? And so I think the question is, how long can that last, where it is just sort of the default? I mean, even their new features that are going to release today are all about, AI and how that ties in some of its hardware. But in all honesty, they're 2 years late to AI. A lot of the features Mark Gurman, our Apple colleague, is reporting that won't really release until 2025, at which point maybe you should just wait for the iPhone 17. And I just think there's a big question about, Apple's products are still good. They still make, the best laptop, the best, watch and earbuds. I'm talking through my AirPods right now. But at the same time, when they don't face that type of pressure, does their products just become too incremental and too boring? And I think that is when you're going to see a lot more disruptives trying to change the way computing works and work outside of the Apple ecosystem. But the problem for consumers like us is we're kind of stuck in it. I'm not going to switch anytime soon, for sure.
Well, then to that point, what I found also interesting, and I didn't know in the piece that you wrote, was sort of Tim Cook's role in managing Apple's supply chain. And you dug deep into Apple would have a supply chain partner and then in essence look to manufacture that in-house and then boot that company, which has really messed up tons of companies around the world. Can you give us some detail on that?
Sure. The most infamous example actually goes back about a decade ago. Apple was developing these new sapphire screens that were going to be ultra durable instead of the glass that they currently use. And they sort of outsourced it to a partner and then left that partner on the hook with all the liability when Apple decided not to go that route because the Sapphire wasn't quite going as fast as they could develop it for the iPhone. And I think that we sort of position that as symbolic of what Apple has seen with a few of the partners they've worked with over the years, not just in the supply chain, but also on the software ecosystem side. It's really fascinating, all this sort of trend that we see of a partner really excited to work with Apple in the beginning, like Goldman Sachs on the Apple Card, or even General Motors, we cite as another example of working them on CarPlay. And then years go by, and suddenly they're not so happy with the relationship with Apple anymore. And I think that really has become a trend in recent years as the company has grown to this massive multi-trillion-dollar force that essentially it's Apple's way or the highway. And I'm just curious how long that will last with partners before they say, you know what, enough is enough.
And Austin, I think for a lot of investors, one of the longer term issues that's still always out there and is probably increasing in concern is just the regulatory risk for not just Apple, but kind of big tech in general, but certainly for Apple, given their marketing position. How do you think the companies how do they react to that? And just in terms of a long-term threat or headwind?
Well, actually, I mean, the DOJ case in the U.S., they just released their complaint in March. Apple has pushed to dismiss it just earlier in August. That's going to play out over the course of years. I think the preceding cases with the DOJ and IBM or DOJ and Microsoft, I mean, this lasts many, many years. But we're already seeing sort of a precursor to that in what's happening in Europe with the Digital Markets Act, which has already pushed Apple to change a ton. In fact, right now in Europe, because of those regulatory changes, you can get an alternative marketplace, meaning you don't just have to rely on Apple's App Store. You're actually able to delete a lot of native Apple apps that you can't delete in the US. You can delete Safari. You'll eventually be able to delete your phone app, your camera app, the App Store, and just use alternative products from the third-party ecosystem. And so what you're seeing in Europe is this almost two-track system where they have a lot more flexible sort of computing platform than anywhere else if you're an Apple user. So I think what they've sort of done is take this almost whack-a-mole approach to regulation in the EU, and even in some of the pressure they've seen in the US, they've had to open up that walled garden that as we refer to it, sort of their closed ecosystem a little bit more in a way that Apple doesn't like because they lose control. But for consumers, in a lot of ways, it's a little bit interesting to watch this company have to change and not just have it the Apple approach. They're going to have to, at least in Europe so far, open up their walled garden a little bit, allow some more players within their ecosystem to run some of those fundamental parts.
Yeah, which is why it's so interesting to read the piece, because it really reminds us that Apple wasn't the leader 40 years ago, that it was a very different world when it came to PCs. Well, you can definitely read this Big Take and more on the Bloomberg and at Bloomberg.com/Big Take. Definitely check it out. Really wonderful stuff. Plus, if you're joining us from Boston, Massachusetts, like Austin is, if you're listening to us in Boston, our new home is now 92.9 FM in Boston. I could have done a little bit better, but I did it. All right, Austin, thanks a lot. Austin Carr, technology reporter.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. Listen on demand wherever you get your podcasts or watch us live on YouTube.
Okay, let's get to another top story here that we're looking at. And that's HSBC is looking at potentially merging its commercial and investment bank to cut some costs. We wanted to get more on that with Tomasz Noetzel, Senior U.S. Banks Analyst. He joins us from Bloomberg Intelligence from London. Can you just walk me through why and sort of what this would look like?
Yes, hey guys, thank you very much for having me. So cost cutting, yes, so that's definitely something on top of agenda of the new HSBC CEO, who has just started his position a couple of days ago. So why cost cutting? First of all, we are seeing revenue weakening, outlook is weakening because of interest rates are going down the next 2 years, and the HSBC needs to do something to keep the profitability. They would love to stay at around mid-teens ROTE, and in order to achieve that, they need to cut costs because there's little options to do with revenues.
So what is the competitive position for HSBC? Just break it down for us, because I think a lot of our listeners and viewers don't have a great handle on it.
Yeah, so first of all, we need to understand that HSBC is very much heavily emerging market focused bank. If you are emerging market focused bank, of course, you have much better opportunity to grow your revenues, your growth, your lending. But if you look into the outlook, it's not such a rosy story anymore, because now we have much higher interest rates. Rates are going to go down. GDP is not so growing so fast as it was in the past. So revenue is going to flatten in the next 2-3 years. But if you are emerging market focused bank as well, you are facing higher inflation costs, and because of the higher wage inflation in those markets, etc., your cost base is growing. On top of that, you have to invest in digitalization, transformation, etc. So everybody is doing this globally. So there is massive cost pressure, and looking at HSBC, which is spread across more than 50 markets, mainly in Asia right now after recent restructuring, there's a massive cost base, and they have to do something about this to streamline the operations. They have started this already a couple of years ago under Noel Quinn, and they've done quite a good job cutting costs by more than 5 billion. However, there's still lots of things to be done, and one of those aspects will be definitely headcounts, and then maybe looking into cost base and look at headcounts and try to have some synergies in those two businesses, which will combine have around 40 billion in revenues, will be the biggest revenue driver for HSBC, much bigger than wealth management, which is the key focus of the bank at the moment.
This might be a dumb question, but if it makes so much sense, why haven't they done it already?
Well, that's a good question for CEO who just left, so Noel Quinn, and the new guy is coming, and he has to deliver something, and he has to. Why he hadn't done it before? Because we are living in different interest rate environment, right? We are living in interest rate environment that was supporting revenues, but the conditions has changed, environment has changed. Now the expectation for U.S. rates, global rates are going up and down. The volatility is quite high, but I think we know more or less that the rates gonna come down, and HSBC is one of the most sensitive banks to cut in interest rates, so they have to do something quickly, and definitely new CEO needs to deliver something, needs to convince market that he can get the handle on cost. Cost is definitely a big issue. We have been writing about this quite a lot. You want to deliver, if you are emerging focused bank, you want to deliver revenue minus cost growth, which we call operating jaws. You want to have at around 1 to 3%, and at the moment they are running negative jaws into the future. So it's not a compelling story for HSBC. Hence, cost focus right now is very important, and they will replicate possibly what Standard Chartered did at the beginning of the year, where they also plan to merge two units just to cut costs, and they are able to keep costs flattish in the next 2 years, and possibly HSBC is going to follow the same path.
Tomasz, I'm just looking at the PGEO function to see where they get their revenue from a geographic perspective, and again about half of their revenues comes out of Asia, about almost 40% comes out of Europe, only about 10% out of North America or so. Can they be a significantly profitable and generate the types of returns they need to without having a bigger presence in North America?
Well, if you look at HSBC, they have been very much deleveraging themselves, or they were de-risking themselves, and they were they exited France, Canada. They have some US as well. They cut on the operations over there. They are heavily focusing on Asia at the moment, and Asia growth is what they want to leverage and embark on. They definitely look into wealth management, and if you look at news stories over the Bloomberg, there's lots of stories. They're hiring more people in Hong Kong, more in Singapore, because they want to really compete with wealth management, and this is the area of their growth. And whenever they talk about interest rate cut, interest rate, lending growth is very difficult at the moment. So wealth management is definitely something they want to explore further, and that is the area of growth for them. It's in Asia, but also in Middle East, where we have the largest number of billionaires come to the market, and they want to definitely capture the opportunity in this area.
All right, Tomasz, thanks a lot. Tomasz Noetzel joining us, Senior EU Banks Analyst for Bloomberg Intelligence.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We cover all the top news in business, economics, and finance through our lens of our Bloomberg Intelligence folks. They cover 2,000 companies in 130 industries all around the world. We also like to take a broader view and kind of step back and look at what the pros are doing. And for that, we go to Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management. They have just under $8 billion in assets under management. Great person to talk to, Chuck. Do you care if the Fed cuts 25 or 50 at the next meeting, if they cut 75 or 50 for the rest of the year?
I do care because of the message that it sends.
Okay.
In terms of the economic impact, that's likely to be small, 25 or 50. I don't think the market is on board with what they're likely to do. I think they're going to do less rather than more. The market's priced for 125 basis points between now and the end of the year. And I just don't see that as feasible without a recession.
So we had a whole slew of economic data last week, culminating with the jobs number on Friday. It appears the economy is slowing. Is it slowing at a rate that, A, do you agree with that? And are you concerned that maybe it's slowing too much?
It is definitely slowing. But as I joked, good luck trying to avoid getting a traffic ticket if you tell the cop you slowed you slowed down to 100 miles an hour in a 70 zone. That's not going to fly very well. The economy has slowed. We're growing at a more moderate rate, but we're still growing north of 2%. And fundamentally, that's a very solid growth rate. Productivity is adding 1.5% a year. Domestic labor force is adding 0.5% a year, maybe. All of the rest is coming from immigration. And so we have the capacity to grow at 2% a year. We're doing that. So that's very solid growth.
So if we have that solid growth, is it that the Fed will cut less in the short term, but the amount of cuts overall in the cycle is the same? Or do you think that we need to start, and I mean investors, need to start paring back what they think neutral is?
Well, I think that the market has a bad sense of what neutral is. Okay. And one way to see that is people say that monetary policy is very tight. They look at the funds rate and they look at inflation and they say interest rates are high. True. If you look at the 10-year, however, relative to inflation, the real rate on the 10-year is not very high. And yet that's the rate that matters much more for corporations. It matters more for mortgage rates. It's a much more critical interest rate. And on that basis, monetary policy is not tight. It might even be considered loose.
So given that backdrop with the economy, with the Federal Reserve, where are the best opportunities these days for you? Do you find them in the equity markets, in fixed income? Are there certain sectors that screen well for you?
Fixed income is not that attractive, especially because the market is anticipating a lot more cuts than I think are likely to come. But the equity market, I think, offers good value, especially the disliked, unloved S&P 493. The Mag 7 obviously are through the roof, and I think a reasonable case can be made that justifies that. They all have high growth rates. They have enormous growth potential. Companies are typically doing very, very well. I think you can look at them, you have to look at them actually one at a time and judge their prospects. The 493 are relatively ignored. And there's great value across the board in whole sectors. So it's not hard to find stocks with good, solid prospects, good dividends, and trading at 10 times earnings or even less. So that's real value.
So, okay, so where, I guess, what spaces? Like, are you going to go like deep cyclical there? Do you just look for value? Is it dividend players? Is it going to be just safety trades in those 493?
Well, I manage a portfolio that is income oriented. We call it income with growth. So it's an equity-based, income-oriented portfolio. I've got lots of exposure to the energy sector through master limited partnerships, oil and gas partnerships. I've got lots of exposure to business development companies, very high-yielding companies because they require to pay out their profits. I've got exposure to parts of the REIT market where I think there's real value. And then there's the banking sector, the financials. The financials are typically still cheap, still offer very good dividends, and they're very well capitalized, and the companies will do well.
So you mentioned banks, financials. Do you have exposure to regional banks as well?
Yeah, a couple.
And how concerned are you about commercial real estate and the exposure there? Because Alix and I, this is something we probably try to get as many guests on as we can to talk about commercial real estate in general.
Well, there's no question that the office space market is problematical, but that's only a small fraction of the overall real estate market. I've seen numbers like 6 or 7% of the total commercial real estate market is office. The rest of it is fine. The part of the market that I really like are nursing homes. They got crushed during the pandemic for obvious reasons. The stocks are still cheap. Business is recovering, not surprisingly. Occupancy is rising, rates are rising. Their biggest problem is getting labor. Labor costs are rising, but profitability is improving. They pay high dividends, perfect for my strategy of income with growth. We're producing over 6% yields on that strategy. And we've still got some growth embedded in there as well. So it's a great way to generate income in a cheap part of the market.
So staying on that for a second with commercial real estate, aside from office, we generally hear like student housing, senior housing, and also warehousing. Is there like another leg or something to that that's also interesting to you in that space?
Well, it's all one-offs. So, for example, there's EPR Properties, which does experiential type of things. They own Topgolf outlets. They own movie theaters. The movie theater business is struggling, obviously, but it is coming back. And Topgolf and other parts are doing well. So that's an interesting play. We own it. So there are lots of opportunities. You just have to dig.
So when you talk about your dividend strategy, I guess almost by definition, you don't have a big exposure to technology. Because I look at a company today, the story today is Apple and the new phone launch, and we're covering it like crazy here at Bloomberg. But you look at this company, they got $150 billion in cash, they're going to throw off $100 billion a year in free cash flow, no dividend.
Okay, you should know that this is a point of contention
is a thing
for
for
Paul.
me.
He gets very upset by this.
I argue with Tim Cook about this all the time, at Duke, usually over a cocktail. But what do you say? How do you think about the technology companies and dividend, given all the cash flow they have?
Okay, so as a fiduciary, we've got a diversified portfolio. So we have to have some exposure to technology.
Okay.
There are companies that pay dividends, and they're still doing fine. Seagate Technology is one of the ones that we own. Broadcom is another. We've owned that one for a while. These are among our lowest yielding holdings in the portfolio strategy. Nonetheless, it gives us some exposure to technology, and Broadcom is going to benefit from AI. So we're playing that game too.
And it's been one of the most undervalued plays versus like an NVIDIA. It's really underperformed from that perspective too.
Well, it's undervalued in that it hasn't performed as well as NVIDIA, but then few things have. But it's great value and will do fine. And we're long-term players. We're not trying to make the buck in the next 20 minutes.
Tax policy. It's an election year. Tax policy is going to be front and center here for both candidates. What's it mean for, again, an income investor like you?
It matters a lot. So one of the things that we look at is how is the tax treatment of the dividends that we produce. We prefer ones where there's some shelter, which MLPs do. It's great. The REITs do as well. Interest is taxed at full income tax rate, so that's not as great. And we don't have a large exposure there. And actually, our exposure to fixed income is a little bit below average. We try to be 80 equity, 20% fixed. We're more like 15, closer to 15 fixed right now because we don't see the bond market as particularly attractive.
So if corporate taxes, say, are raised, does that change then the dividend payout situation that you're talking about?
It will hurt. but it will hurt everything. All stocks will be worth less because of a higher dividend, a higher tax rate. So you have to pick your poison. And the question is, which ones will be hurt the least? Again, if it's a matter of full tax applicability, like for interest, that gets hurt even more than stocks. In the case of stocks, some pay return of capital, they will be hurt the least. So yeah, it will affect some of our allocations.
When you sit down with the management teams of the companies you own, and you talked about use of cash and cash repatriation, buybacks versus dividends, what's the discussion like? What points do you make?
I love it when they do buybacks, but often they feel like they've got to do some dividends to placate shareholders. Look, however they return capital is good. If they're producing enough free cash flow that they can afford to buy back or pay out higher dividends, either one works for me. Theoretically, I shouldn't care. That's what the mathematics say. As long as they return capital, are profitable, and they're growing their earnings, and their return on capital is high, I'm happy.
If we see increase in capital gains tax, how do you think about that?
Again, that hurts. It hurts the valuation of these companies, and so, but it's an across-the-board type of damage. It will hurt the valuation of the entire stock market.
So what's the big issue that you're focusing on right now with your team?
Well, I think the issue that everyone's struggling with or talking about is whether or not the economy is likely to lapse in a recession anytime soon. I think the answer is no. When I look at the economy, I have a tough time constructing a recession scenario. The easiest way to make that case is to say that interest rates have gone up a lot and that will cause a recession. Well, we've been sitting in that boat for a long time and it hasn't happened. And there's a reason it hasn't happened. The consumer is in very good shape. Job growth is still solid. Income growth is even more solid. So consumers have the capacity to spend, and that's 70% of the economy. Capital investment, we're trying to promote green initiatives. We're trying to bring business back to the U.S., manufacturing back to the U.S. That's a tailwind for the economy. We happen to have a severe housing shortage. So even though mortgage rates are high, it hasn't crushed the housing market as much as it would have if we didn't have that housing shortage. And if interest rates dip, you're going to see housing take off like a banshee.
All right, great stuff. Really appreciate it. It was so good talking to you. Chuck Lieberman, co-founder and chief investment officer at Advisors Capital Management, joining us there.
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
So one stock we're watching today that's doing absolutely nothing is Starbucks, trading at $91.16. It's literally flat on the day, but it's a big day because incoming Chief Executive Officer Brian Niccol has to live up to the hype that really propelled shares higher. It's his first day as CEO of Starbucks. Michael Halen, Bloomberg Intelligence Senior Restaurant and Foodservice Analyst, is joining us now. First of all, how long do you think the market gives him before they judge him?
Yeah, it's tough to say, right? I think really it's going to take some time. You don't turn around an aircraft carrier on a dime. Starbucks is a behemoth of a company. So I think the market gives him some time. He's got a phenomenal track record, right? What he's done at Taco Bell and then Chipotle, obviously, were very impressive. And he's really, the first thing he's going to do, I think, is just try to change that culture, right? Bring in a culture of transparency, accountability. He's going to talk about hard work and compensating his employees for doing a good job, because those are some of the things he talked about changing at Chipotle on his first earnings call there. So all that stuff's going to take a little bit of time, and because of his track record, he'll get a pretty long leash, I think.
What are the challenges facing this company? Because just as a consumer, I mean, the Starbucks on Route 35 in Wall Township, New Jersey, they do a great job. People are great. It just works like a charm. Store's in great shape. The one in Summit's good. It's always packed. What do they need to do here? I don't think anything's broken.
Well, it depends on the store. It sounds like that location is doing pretty well, but they have thousands and thousands of locations across the globe. I mean, in the U.S., operations is a big issue. Drink orders have become more complicated. Digital orders have kind of changed the experience for the in-cafe customer, right? Like it became popular because the baristas knew your name, right? And the level of service was phenomenal for a chain of that size, right? And through digital ordering and these very complicated orders, they've lost some of that, right? And so operations, they're losing a lot of orders because people are trying to place them on the app, and the wait times are kind of obnoxious at times, right? And so I think operations is going to be his primary focus. Running the best cafes possible is really going to be job number one. But there's a bunch of different issues. Operations is just one of them. Politics has been an issue, right? Starbucks has always been a brand that kind of puts their politics in your face, and I think Brian Niccol is going to want to step back from that, right? Because of all of all the issues they've had with their customer base, right? People haven't been happy with, there's been some boycott talks online about their stance on the Israel-Hamas war, about their stance and how they've handled the union negotiations, so that's a big thing. And then, we think eventually, once they have the stores running really, really well, they're going to start spending some more money on marketing. Maybe not a ton of money, but we would expect them to start spending on marketing. It's not something that Starbucks has traditionally done, but it also wasn't something that Chipotle had traditionally done, and it's been paying them dividends now for a handful of years.
So the thing with Chipotle, though, if we just and maybe Paul can attest, is it like there's a menu and it's basic, like there are add-ons, right? But like it's a basic menu. Starbucks menu is like explosive. Like they can't even have all the options up on the ordering board because there are just too many. So does working with operations and getting that better mean they have to pare back their menu and get back to their base?
Yeah, probably. We had been critical of the previous management team because they kept rolling out new menu platforms, and then in the next breath talking about improving throughput. But you can't have both. So we fully expect them to pare back this menu, make it easier to execute in the cafes, right? Make lives easier for their employees and get the orders out faster. So yeah, I think that's going to be a major part of what they do going forward.
I mean, Bloomberg had a story from in 2023 where, the variations, if you add up all the potential options, there's like billions of different types of drinks that can be made.
Oh, yeah.
So it's just out of
and
control.
There's like the cold drink, there's the tea, there's the refreshers, then there's the frozen refreshers, and the blended refreshers. And I know this because my daughter likes those things. Yep. But sometimes you get them frozen, and then sometimes they're not. It's very complicated.
I know. I don't know how they do it. My hats off to them. All right, let's step back and look at the restaurant space in general here. You've got some research out recently. Restaurant promotions, marketing heat up. That's not what shareholders want to hear, do they?
No, but restaurants are kind of desperate right now to get some traffic into their stores. Low-income consumers' spending has been very weak. This seems to be spreading to the middle-income consumers, right, based on the industry data that we've seen, which showed an improvement last month in August, but it was still negative at casual dining restaurants, at family dining restaurants, and at quick service, right? And so they bounced from that horrific July numbers that we saw, but still are negative. And so, yeah, restaurants are trying to do whatever they can to bring, those low-income consumers and middle-income consumers back into their restaurants. Just for example, it was, I think it's 35 out of the last 37 quarters quick service chains have had negative traffic, right? And so that's not a sustainable type of situation when you have same-store sales rising because your prices are going up, but traffic continues to decline. Eventually, there's a tipping point, and that's what we've seen this year.
So to that point then, which ones do you have faith that can maintain some kind of margin and also grow their top line?
It's some of these chains that have a big gap on pricing, in terms of, they've been pricing less than their competitors, right? So if you're providing a lot of value, and value can be two ways. It can be a better price, but it also can be a lot more food for what you pay. But some of these companies that people see value at. Wingstop, Chipotle, Texas Roadhouse. These are all of the chains that have been outperforming. These are all of the chains that have been able to drive traffic, and a big part of it is being priced below competitors. Wingstop's raised prices about half as much as their competitors, and on their last earnings call, they credited that as a big reason for their phenomenal quarter.
All right, Michael Halen, thank you so much for joining us. Mike Halen, he's a senior restaurant and food service analyst, Bloomberg Intelligence, joining us from Princeton. Talk a little Starbucks, first day for the new CEO there. I'm happy with my Starbucks.
You don't drink Starbucks?
I go like once a week.
Oh, okay.
I used to go more often, but double short mocha, very easy. What's your go-to?
Oh, yeah, okay. It is an Americano, sometimes ice, sometimes not, half calf, almond milk, 2 stevia.
Wow.
Which actually, for a Starbucks order, isn't really that bad.
Yes, that's not.
Like, there's no syrup, there's no whippy things. It's
Okay. I think the younger you are, the more creative you are with your coffee orders.
Why, thank you.
I'm just
so
saying.
Sweet.
I mean, and some of the kids come out with these things. I'm like, how many derivatives of a basic cup of coffee can you have there? But apparently there's a lot. But again, Starbucks. Who knew?
You're listening to the Bloomberg Intelligence Podcast. Catch us live weekdays at 10 a.m. Eastern on Apple CarPlay and Android Auto with the Bloomberg Business app. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Alix Steele here alongside Paul Sweeney. This is Bloomberg Intelligence Radio. We bring you all the top news in business, economic, and finance through our lens of our Bloomberg Intelligence analysts. They cover 2,000 companies and 130 industries all around the world. Every Monday at this time, we like to bring you another arm of Bloomberg, and that's Bloomberg NEF, originally or previously known as New Energy Finance, or the team in Bloomberg that tracks and analyzes the energy transition, from commodities to power to transport to industry buildings and ag sectors. And here with us for more is Brenna Casey, Bloomberg BNEF carbon capture analyst. Brenna, we take a look at, say, how carbon capture has grown, the amount of money that's been put in. So sorry. Paul has a question.
First, this is a pre-question. Can you define what carbon capture is?
It's probably the better question.
Yes, yeah. So basically, simply, CCUS, carbon capture, utilization, and storage, it's kind of just a way to abate emissions from heavy industry. So things like petrochemical refineries, integrated steel mills, hydrogen, blue hydrogen. Natural gas processing is a huge historical end use sector.
So basically, there's some sectors that you cannot decarbonize, and they have to exist. Like you need cement, for example. So this is a way to kind of get them out of the air. And then the question is kind of, what do you do with it? Do you reuse it somewhere? Do you put it somewhere? Do you store it in a rock or somewhere else? And it's been a huge focus for a lot of companies, energy companies and alike, and oil companies, for example. What has been the investment cycle like, and where are we now in that cycle?
Yeah, so if we're looking particularly to the U.S., following the Inflation Reduction Act, we saw this catalysis of not only project announcements, but kind of, Series A, lots of equity financing into that, into the market. Right now, as, the IRS has still yet to address 45Q. So that's the Inflation Reduction. Yeah. So the Inflation Reduction Act, which was signed into law, 2 years ago, 45Q is an investment tax credit that the government is proposing to, heavy emitters. They can, if they meet XYZ requirements, then they can take this credit and apply it to their tax burden, and kind of helps to mitigate the cost of CCS because it's extremely CapEx intensive.
So if you store your carbon or get it out of the air, you get a tax credit.
Okay.
It's like $85 per ton if you store it, and then $60 if you utilize it. Yeah, exactly. However, the IRS has yet to finalize the criteria, so developers don't know what actually constitutes as a project that can qualify for these sorts of credits. And so what we've actually seen is not only investment taper off, but just announcements of future projects into the sector. What's kind of ironic is that if we look at investment numbers for last year for CCS in total, it was globally $11.3 billion, higher than it's ever been before. The U.S. took home around $2.8 billion of that. However, that is all bolstered by just DOE grants. So the DOE has these direct air capture hubs. They're trying to throw money at growing out midstream infrastructure, so transport like pipelines, the storage like storage basins you mentioned earlier. But there's really no FIDs being taken in the sector at all. Besides, I think it was the hydrogen Beaumont complex last year.
So FID is foreign investment decision, final investment decision,
yes.
sorry. And it basically means like, okay, I have enough and I understand enough of the economics where I can actually like put money in the ground and like put a shovel in the ground and do some stuff. And that's where we're really lacking, which raises the question, is it building the stuff is still too complicated, or is it the demand side? So I'm a company and I'm like, I can capture your carbon and I can store it for you, but how much are you willing to pay for that? Is that part of the issue now?
Yeah, it's definitely kind of a sector by sector issue. So if we look to power, we're seeing the most cancellations in the power sector just because CCS is tremendously expensive. And so if we're seeing a project announced, around 30% of those projects in the power sector are like, they're probably going to get canceled. And that's because retrofitting with CCS adds around 56% to the total LCOE. So it's 800 million plus CapEx investments. If you look to something
which
like,
also then how do they recoup that? Because
exactly.
about power, it's either the company's paying for it or like I'm paying for it in my bills, right? And that's a different way of how they recoup that cash.
Especially if, the 45Q credit, if you are an emitter to qualify, it only lasts 12 years. A lot of these lifetimes are 20, 25 years. And so, yeah, how do you kind of make that investment back?
Carbon capture losing some momentum because maybe just the transition to green in the U.S. has become a little politicized and maybe it's losing a little bit of impetus? Are we falling behind other countries, for example?
The U.S. is definitely the market leader. So
okay.
Globally, there's around 424 million metric tons of CO2 capture capacity due to come online by 2035. Now, out of that, around 163 million tons is based in the U.S. And following, the 45Q, Inflation Reduction Act, even though there's, hiccups here, hiccups with transport and storage permitting, we do see the United States as the best place in the world to kind of build one of these projects.
So what companies do you feel like have the real deal? Because I talk to a lot of companies and they're all going to try and sell me their carbon capture products and why they're the best and how their economics work and all that stuff. Who actually can make this work?
Yeah, if we're looking at power and hydrogen, which are the two leaders right now, kind of the biggest players here, we're seeing Occidental Energy. So not only are they looking to retrofit their, natural gas assets with carbon capture, but they're also kind of taking this first mover run into the direct air capture space. So that's a really interesting company to watch in that kind of little corner. There's also, like air products for hydrogen. ExxonMobil, it's primarily these oil and gas majors that are moving around in the market because they have, just previous expertise, but they also understand the geology, how to store these things, how to build, these big expensive projects. Air products, Oxy.
So Oxy is one of the pure players for E&Ps, for oil and gas, but you talk to the CEO, and she wants to eventually basically be a rent for hire direct air capture. So meaning like, hey, I need you to capture some stuff, and you build a plant near a factory or somewhere else, and you just suck carbon out of the air, and then therefore you're able to separate it and then store it somewhere or reuse it. And that's like what they want that business model to be. Amazon signed an offtake with them. They wouldn't tell me the price. They're like, it was really hard. Like you can get the offtakes and like the buyers like an Amazon, but it is really expensive yet. Like it hasn't become easy on that sense. All right, Brenna, thanks a lot. Really appreciate it. Brenna Casey, Bloomberg BNEF carbon capture analyst. I obviously find this really interesting.
I know, I did too. That's why I love it. It's good stuff.
And the idea is like you can do green all you want, but like we're not starting over from scratch. So you actually need carbon capture to get the existing emissions out, because how else do you filter that? You can get trees, and that's awesome. Like we want trees, right? Maybe the ocean, but we need all the things to make all of this work.
I'm learning.
This is the Bloomberg Intelligence Podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live each weekday, 10 a.m. to noon Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.